Fobby on the beat. Talking leadership, making the big plays in the mortgage game through the sun and the haze. Close more deals, build your success. Time to level up and beat the stress. Get ready to laugh, land and eat. Laugh, land and eat. Your weekly C. Let's go.
All right, everybody. Welcome back to another edition of Laugh Underneath the Podcast. I am your host, Bobby Nagmi. So, James, I just started saying that. It feels so awkward.
Well, why? It's your podcast.
I know, but I've never, this is the first time in 7 seasons that I've actually done that intro like that.
What do you normally say?
I just start talking.
Yeah. Get right in there. Yeah. No foreplay.
I really just start talking. I don't know. And someone said, well, why don't you ever do a full-on intro? And I was like, I don't know, man.
People know. Like, they already clicked on it, right?
So, I think so. We're getting about... I think we get about almost 1,000 downloads per episode now, something like that.
That's awesome. That's great.
Yeah. So we're about to start monetizing it, Jay. This is my retirement plan.
There you go. Get some advertisers.
Yeah, I think there could be worse things to do in life, right?
You could move to Costa Rica. Yeah, you could do a podcast.
Anywhere.
I
could take my student to Pakistan. I might be safer in Pakistan right now anyway.
Yeah, I'll give you that.
They're not, I think, anyway, I don't want to go down. See, that's that magnetic pull we were just talking about before the show started. See, that's what I'm doing, man. I'm staying away from the magnetic pull. That's what happens. So, listen, we have James Kleiman on here. He's going to be our co-host, stepping in the big shoes of Justin. He agreed. And obviously, everybody knows James Kleiman because he's got the mortgage scoop. He's been around. He's in his own words, he's a gossipy little bitch.
Yeah.
And so
probably should have come up with something better than that.
I wish you had to, but hey, everything goes on this show. So listen, James, obviously we got a few minutes before our guest comes in.
Yep.
I know there's a lot of things going on in this universe of ours, right? I guess the biggest, I didn't see that coming. Right, that wasn't on my bingo card. My NCAA bracket is totally blown. Whatever line you want to use, right? Bill Pulte is like Jason Bourne or something. What's going on here?
Sort of, yeah. So, it was Tuesday. It was Tuesday morning, and a buddy of mine sends me a text message, and he said, "Bill Pulte is now Kash Patel's boss. He's going to be running national security." And I thought it was a joke. I thought it was like an Onion article or what is it, the Sacramento Bee or something like that. So I ignored it and I did a little workout. I got on my rowing machine and I came back like 40 minutes later and I had like 100 text messages, a bunch of missed phone calls. And I realized like, oh, wow, this is real. And so Bill Pulte was named by President Trump via, I guess, Truth Social tweet.
It's no way where the presidents do things nowadays, yeah.
Yeah, which means that he will be overseeing 18 intelligence agencies, including the FBI, the CIA, the NSA, I think ATF, and a bunch of other acronyms whose names
something that nobody knows. I'm going to give you the scoop. I got a text from Trump on Sunday night offering me the job, and I had to turn it down because I was busy with the podcast.
Oh, geez.
I didn't think my brain could handle it.
Do both, because Bill Pulte is going to be doing both.
Yeah.
FHFA as well as running the security apparatus.
I'm sure they're going to find somebody else to run FHFA, right? I mean,
I don't know.
They have to. But okay. And I'm not joking, by the way, on this one, right? I mean, we joke a lot, but obviously, you know what I mean? But I see a lot of mortgage company do what's being done right now, right? Like, yeah, throw that on him. He can handle that also, right? He can do compliance and underwrite files and do marketing and do, right?
Yeah, he's the chief risk officer and he's also like, the head of sales or something, So
it's a very businessman attitude that Trump is doing. Like, just he'll take care of it. It'll all work out.
I don't think, this is just my opinion here, I don't think he even considered any of the implications for the FHFA or Fannie and Freddie. I think it was, we have this hole that we need filling with, Tulsi Gabbard leaving and who has already received the Senate confirmation. And who's loyal. Like, who do I know 100% is always going to back me and always going to support whatever it is I say or do? Bill Pulte's going to be on that short list. And so he's got about 200 something days, because I don't think he's going to receive a full Senate confirmation to become a permanent director, but he's got about 200 something days to national security, be Kash Patel's boss.
Hey, listen, man. I mean, at this point, I mean, I'm just glad we're still like breathing and living in a country. I don't know, man. I just want to get retire.
Yeah, I would be surprised if he has the security clearances to do the work that I imagine. I'm not like an expert in national security. I've never done reporting of that stripe, but I would be surprised if he had security clearances to read all of that sensitive, confidential information that one would need to make good assessments. So that's the first part. The second is, like, he has had some data related initiatives that have been, it's been argued, have been politically motivated, and if you're overseeing the NSA, the FBI, I think that is something worth.
Well, I remember Bessent, the Treasury Secretary, like wanted to punch him in the face or something a few months ago.
No, what he actually said is, "I'm going to punch you in the fucking face." At a dinner party in D.C. that they because Pulte was allegedly talking smack about Bessent to President Trump. Right.
So I think this is like, listen, I just, I'm like I said, I'm a happy citizen of America. How's that? Let's leave it at that. Yeah. Let's move on to cross country and UW. The saga continues, right?
Saga continues. Yeah, it sounds like
you thought it was all over to go back and start originating loans. It's like not ending.
The vote has been postponed to June 11th, and what that means is, I think what that means is that the board at Two Harbors didn't have the votes to accept the CCM offer. And so they need to drum up more votes, right? They need to find a whip who can get them whatever.
You think they're getting greedy because the UWM offered more money?
So I'm not an expert on, trying to figure out like all of the various components of the deal, but UWM has made several offers since the initial was accepted and then rejected. And, they made a bunch of comments that the leadership at Two Harbors, wasn't any good. Basically, they said these guys suck and we don't want them. We just want the MSRs. And, so the problem with UWM's offer, as I understand it, is although there is now a cash component, it was originally just a stock deal. Their stock was really struggling. It's even worse now than it was when those deals had been rejected. So, by the day, it's going to change what the value is because it's pegged to the value of the stock. But I'm just so tired of it. I don't.
It's not worth reporting anymore, is it? Yeah.
I kind of checked out a little bit.
Did you hear about Movement Mortgage losing another large team?
Yeah, I broke that story.
Yeah, that was you, right? I wasn't sure if you broke it or somebody. So who was that?
They had a team, $100 million team in South Florida that just left, and they are joining Victor Ciardelli at Rate.
Okay.
And they had a good number of solid producers there. Tyler Esposito is one for there's
any yoga pants on the offer? Yoga pants for life?
So people do get discounts for, I don't know about Rate Outdoors, but they do get discounts for yoga pants and gym shorts and stuff like that. But the team, the market leader for Movement down there was a guy named Travis Marchand. And it sounds like they left, or their license is transferred, I should say, about a week ago. So it's a good win for Rate.
Yeah, but they had Peter Zamp come back up in Nashville. He went to Primus and he came back.
Yep.
He was about another $150 million guy.
Yeah, Movement's had a couple people who have kind of boomeranged back after decamping for other places.
And Nicole Ruth out in Colorado, she left. And I mean, I think she's still at cross country. She hasn't like.
She's at cross country. Yep.
Yeah.
She left not too long ago. Yeah, she's very solid. She's really good at what she does.
Yeah, I mean, I don't think any of them are bad. I think it's just as a movement mortgage loan officer once said to me, it's a big carousel that we all sit on.
Yeah.
And it just goes around and around. So
and movement, they've been really busy in terms of trying to change their infrastructure. They've completely flipped their entire tech stack over the last couple of years. They implemented a new LOS, Blue Sage, and that was finalized a couple months ago. So that's new. Obviously they've had some changes in leadership. Jason Stenger left also for back in, I want to say October or something like that. And, Steve Smith is now running things at Movement. I hear Casey Crawford is not as visible as he once was at Movement, that he's a little bit more active with the Movement Foundation. So, these things, like, businesses move in cycles as well, right? It's not.
Sure. I mean, look, you can't always just be on the top of mind of everybody, and sooner or later, it just all works out anyway. It all works out. Yeah. Anyway, normally I tell you got to go now, but this time you get to stay and see what happens in the last 40 minutes of the show, man. I think this is a new moment for you, James.
I'm looking forward.
We had you on one time out of the show for the whole show, didn't we? Yes, we did. So look, we got a pretty cool guest today. So I don't know. I think you know him because you kind of like filled me in on him. And Justin Wiseman from the MBA. He's like the top voice.
Great guy.
Really anything that touches residential mortgage regulation for the MBA. So let's bring him on in here. Justin, where are you? There you are, Justin. Welcome to the show, buddy.
Hey, great to be here. I really appreciate y'all's rundown. That was comprehensive and interesting. I was watching with my popcorn backstage.
Well, with James, it's he's very the one thing I've learned about him, he's very what's the right way to say it? Detail orientated with a little bit of F you attitude. And so you got to learn to navigate.
You're saying he's a journalist, basically.
Basically, yeah. He's a real life journalist, you know what I mean? Like the ones that used to be back in the 1940s. That's the way I kind of classify him. And he's got the hat to prove it. So
that's great.
Yeah. So Justin, how's it going in DC land with the MBA and everything? Everything going well?
It's great. Things are obviously moving pretty quickly. You covered some of the big developments at the top of the show, but we're also excited about opportunities to possibly push forward regulatory priorities at the CFPB and elsewhere, right? We saw a mortgage finance executive order, and we have the road to housing bill that's before Congress. So it's an exciting and chaotic time, but the main takeaway is, like, for the first time in a long time, housing really is top of the agenda because people are beginning to understand that housing affordability and the lack of young people to be able to afford a home is both a societal issue, but also, we live in a political world, a political issue.
Yeah. So before we get down that road, I want to talk a little about Justin Wiseman, if that's okay with you.
Absolutely.
You have a pretty
I'm an
interesting
expert on that subject.
Yeah. So, I mean, you're basically, I mean, for better lack of word, you're like a lawyer. I mean, right?
I am not like a lawyer. I am officially a lawyer. I've got a bar membership in Maryland and Washington, D.C.
The federal district court in Tennessee, right? In Tennessee, the federal district court, you were a clerk there.
I clerked in the Middle District of Tennessee after Emory Law School for a year. Great experience, great town. But then came back to D.C. because my family's from around here and got started in policy and got started at the MBA, working for a legend in the mortgage business. Shout out to Ken Markison, probably not listening, but he was a legend for many people in terms of lawyers in the mortgage business. Started working for him, bounced around a little bit, did the servicing portfolio, came back and took over a few other things. And now I'm over our federal facing policy team. So the team that interacts with the agencies, FHFA, FHA, USDA, CFPB, and all that. But I do also keep an eye on the legal stuff because that's kind of my background and some ways my passion.
Let me ask you, man. What is today's Thursday, right, guys? Thursday?
Yeah.
Yep.
What does a Thursday morning look like in the life of Justin Wiseman?
Well, so I have 4 kids, so I'll skip that part. But it's cooking a lot of breakfast and getting a lot of kids ready for school. But essentially, it's looking at the news, trying to work with folks on the team and myself to advance our policy priorities. We have, and I'm sure we'll get into them, various irons in the fire or policy priorities before the agencies we'd like to see. And then it's reacting to news, informing members about what's going on in DC, but also most importantly, listening to the members, right? We are a member-driven organization, and everything I've talked about, the priorities, how we react to regulatory proposals, and the regulatory proposals that we push forward come from our members. So a lot of it is listening to and trying to do my best in service to the members.
You ever like wake up and like, God, I just think it's time to retire. I think I'm done.
No, because I wouldn't be doing this job. I'd be doing something else, man. I'd be grilling chicken and burgers on a Beach Shack restaurant if I felt like that, which is the dream, right? I'll do that one day. I get up and I enjoy it now. So no, I'm always engaged. And while it can be unexpected is a word I would use. When you see the news, it's always interesting. And so that keeps me engaged.
What do you think, James? What's going through your head?
You know, that there are so many interesting subjects going on federally, and I think a lot of the political races that we've seen recently, almost all of them focused pretty heavily on housing. Like, have you followed the California race for governor? Yeah. Even in LA, right? Like the mayoral race, you know, big broad strokes about housing affordability issues. Tom Steyer is taking a pretty strong position on it. Becerra not as strong. Pretty recent policy changes, but I'm curious. Like, does it seem like every race now has a much bigger spotlight on housing?
I think that's definitely true in your state and local races, right? That is where the rubber meets the road and people sort of hold politicians accountable. I mean, to your point, I think Karen Bass is like the first sitting mayor of LA to have to enter a runoff, which means someone else, got close enough to her to have a runoff in a really long time. And a lot of that's motivated both by affordability concerns, but also I think you have the sort of insurgent candidate in Spencer Pratt, who sort of centered homelessness as an issue. And I think he hasn't centered it in the sense of like, let's help people find homes. He's more centered it in a quality of life issue in Los Angeles. But those things are related, right? It all kind of comes back to the fact that LA is extremely expensive and people who live there are angry at incumbent politicians. So I think part of what you're seeing in all the races, and housing is a piece of this, is anger at incumbents, right? The national, and there's a lot of stuff tied into this, but like the generic ballot is heavily Democratic, which you would expect in the midterms. But part of that is people are just, cost of living is high, inflation is up, and generally people blame the party in power, be it their Democratic mayor or their Republican president, when that happens.
You mentioned earlier, Justin, the Road to Housing Act, and I believe it passed through the House already. Probably going to see some changes in the Senate. Do you know roughly where things stand and how?
So that's a great question. It's actually, a version has passed the House and a version has passed the Senate, and they're different. And we could spend the entire 40 minutes sort of going chapter and verse where they're different. There's bans on institutional investors and things like that that are slightly different. But what needs to happen next is either one house will take the version that the other one passed and pass it kind of as is. So the Senate would take the House version and pass that, and that would make it a law. Or we'd do something really old-fashioned, which is how things used to get settled in D.C., which is have something called a conference committee, where each body nominates conferees, and they sort of hash out a deal that both houses pass. So we're in a little bit of an impasse right now between the House and the Senate. They each have their own preferred version. I think the White House is backing the House version, so that one probably has more of a chance of passing of the two. But it really is an intramural showdown. The House and the Senate, historically have always had tension, irrespective of party. They each sort of have their own prerogatives and think they're the bigger name in the relationship. So we're seeing that play out, which is a historic drama throughout the history of the Republic.
Justin, when you talk about institutional investors, I was concerned. I'm not concerned. I was questioning, like, how much of an impact does institutional investor actually make? Like, do we know, like, percentages wise, right? I mean, I don't know that number.
It's like nothing.
But I mean, they made a big fanfare out of this, and I got excited, right? Because obviously we always think that institutional investors are buying up everything. Is that really?
So they're not. And James is right. Nationally, it's a tiny fraction of the people who buy it. And oh, by the way, they do provide a useful floor on the market, right? They're opportunistic buyers. When we're in a distressed real estate cycle, they buy homes because they think there's value in them, and they provide opportunity for people to live there. So I think it's a little unfair that they're being maligned this way. I would say two things, though, as to why this is such an issue for folks. One is like just the slogan of it pulls really well. Like, do you think people should own homes or Wall Street corporations? if you're sitting in that famous diner in Ohio, there's like two people eating breakfast and 9 New York Times reporters. Those two guys eating breakfast, like, nah, man, I know that's terrible. People should own homes, not Wall Street. Even though no no institutional investors bought a house in that community in 30 years or ever, right?
Right.
So
Exactly.
that's one. The other thing I will say, and again, James, you're right, it is a tiny fraction nationally, but there are certain municipalities like Atlanta and others where it's a significant percentage of the homes. So if you live in Atlanta, you might be getting frustrated. You're like, wait a second, I keep getting crowded out by these institutional all cash buyers. But nationally, no, it's not really.
It seems like more of a local issue that local governance could actually manage a little bit better. What do you think?
There are zip codes in Atlanta where they buy up about 30 to 40% of the stock. But these are very specific zip codes, right? Like we're not talking about even the whole of Atlanta. And so, I this is a straw man. It's a scare tactic that both political parties, they can really kind of rile up their bases because, as Justin correctly said, it is very easy as a slogan to get behind.
Yeah. Well, I want to switch topics here a little bit because I want to talk about something that's dear and near my heart, Justin.
Sure.
LO compensation.
Mm-hmm.
Right. I think this is look, man. Just put my cards on the table.
Yeah,
I've been in the business since 1994.
Yep.
So I know I don't look that old, but I'm 32 years in, right? This LO comp system has changed in 2010. Has never made sense to me. And at a certain point, I mean, we hear like these rumblings coming that the CFPB doesn't think the LO comp will reform, have meaningful impact, blah, blah, blah. But from the street level, when I talk to other people, we all say the same thing, like there should be some kind of reform at this point.
So I agree with you, and it's probably our top regulatory priority. And when we've communicated to the Bureau following the mortgage executive order, that's what we communicated to them as our top priority, right, was reforming the LO comp rule. We also said, like, first get rid of, or not get rid of, but make the changes to the mortgage servicing rule, because that rule is already proposed. But when you start writing new rules, the first thing you should do is write an LO comp rule, because you're 100% right. It was perhaps well-intentioned when it was passed after the great financial crisis, but having lived with it for as long as we have, it certainly needs changes and reforms. The one thing I would highlight is sometimes you see people say, well, CFPB should just repeal the rule. That would be terrible. And the reason that would be terrible is the underlying statute, which Congress needs to modify or repeal, is actually even more onerous. Like people forget, for example, that per the terms of the statute, if the creditor pays the loan officer, the consumer can't pay any like points and fee charges. And the CFPB looked at that and in the rule said, that's kind of nuts. The entire mortgage business kind of works on that model. And so they created an exemption from the statute for those instances. If we were to get rid of the rule, that exemption would go away. So we need to reform the rule. And MBA has 3 big reforms that we think are reasonable and still retain consumer protections, but would make a big difference. The first is allowing for changing compensation on HFA bond loans and other sort of socially beneficial loans. I mean, to me, that's a no-brainer, right? A lot of these.
Yeah.
The second one is where permissible by state wage and hour law, allowing for clawbacks when loan originators make mistakes that cost the company material money, right? Like right now, it's kind of all or nothing. You have to get rid of the loan officer, have really draconian punishments, or do nothing. But a clawback system would hopefully incentivize better compliance and make the market even more safe for consumers.
So when you say clawback, but when you say clawback, you're talking about like cures, like maybe
the cure, exactly.
So the loan officer didn't disclose a proper transfer tax.
Right. Or I accidentally hit 0 on the appraisal and now we have to eat it. That kind of thing.
Okay. Yeah. Perfect.
And obviously there is state wage and hour considerations, like when compensation is earned, what compensation can be clawed back, things like that. So it's a little complex, but that's the general idea. And the last one, which is probably, to be fair, the one that we've had the most discussion about, so I'm interested in hearing your guys' thoughts on, is allowing for loan officers to voluntarily reduce their compensation when there is a competitive offer, so that the loan officer shares in the competitive concession. Because you guys know the business, you're savvy around mortgage. There's only so much the company can concede without totally destroying their margin. And oftentimes they're getting pretty close to that if you look at our performance data. But we think it makes sense for the loan officer who's worked on the deal, invested in the borrower. in a competitive situation to say, you know what, I will, in this case, cut a little bit of my compensation to make the deal happen.
Yeah,
so those are our kind of big three reforms.
Most quality loan officers that I work with are always willing to go and say, look, Fob, you know what I mean? I'll take less, just make the deal happen.
Right.
And I'm like, I can't pay you less. You've already disclosed the file. We're like 72 hours from closing. Now we just got to figure out how to make this and save the deal.
Right. So those are our three. And I think the folks who say the CFPB is not interested in it are kind of overreading the executive order. It is true that LO comp is not in the executive order, but we have a working group that's working really hard on putting some, actual meat on the bones of those proposals. And we're optimistic that when we present them, the Bureau will consider them. But it probably won't be at the front of the line.
Not asking for a timeline, Justin, because obviously that's not. If there was a magic ball that you could say, Fob, probably by the time you retire, this will be changing.
So I'm working on it every day. So I don't know when you're going to retire, but I'm going to keep pushing it and hopefully make it happen before then. Yeah.
Because I mean, it would literally. I mean, I wouldn't have as much white hair if this all white hair came after Dodd-Frank. Just FYI, I'm just letting you guys know that.
I believe it. And to address you guys didn't raise this, but one thing that's important to point out, because we hear this objection, is nothing we're saying would change a lender or loan officer's fair lending obligations.
Sure.
So we sometimes hear that the concessions will only go to guys that look like me. If you have a pattern or practice of doing that, you have a fair lending problem that exists 100%. Irrespective of the LO comp law.
Yeah, I mean, look, we that was prior to 2010. It was the same policies. Like if you were always giving breaks to certain minorities or certain majorities, then it showed up at when they did those reports.
Yeah.
But at a certain point, I mean, it's like I know, like as a loan officer, they're trying to get every deal to close as compliant as possible. And if that means that they make less money, sometimes it's okay for them. They're not going to do it on every deal. And just like any company, they want to stay in business. But yeah, man, I think LO comp is it's something that's now one last thing. And I know you guys don't have this, but the brokers.
It doesn't need to be the last thing, man. It's your podcast. You can keep
on this topic, right? I could talk about this for like 3 hours. You know what I mean? But listen, I mean, I was doing subprime making 7 and 5/8. You know what I mean? So what am I complaining about? But brokers are saying they deserve better compensation rules also. And I know you're mortgage bankers, not mortgage brokers, right? But do you see a change in their compensation plan?
So I'm interested. I mean, we don't hear those complaints. What's their general complaint? I think right now brokers by rule, and it's legal, have flexibility when they switch between borrower paid and lender paid. They have different at the brokerage level, not the individual employee level, but the brokerage level, obviously they can have different price points or different rate sheets from different wholesalers. So I'm interested sort of what that complaint is, because that's not what I've heard, but
what I've heard is they want to be able to do both like we used to do prior to 2010, where you could get a little bit from the lender and a little bit from the buyer.
That's a tough one under the statute, but I would expect that if they have their advocacy organizations and the folks who advocate on behalf of the brokers are really sharp, I'd love to see how they sort of get around that and put in the reasonable safeguards that the statute sort of was passed to protect.
Well, it was something I heard, and it just reminded me that sometimes I remember in 2009 when I first heard the brokers saying, "Hey, we want to have the above par pricing because we give that to consumers as credit." And I remember reading that, and I was like, "Oh God, they're setting themselves up," because no one was giving credit to the borrowers back in those days. I'm just telling the truth. I mean, they were eating all up, And so, anyway, James, your time.
Well, yeah, I've done a lot of reporting on this, and I think Justin is hitting it right on the head there. And that I think most LOs that I talk to are. They don't bring up point number one that he brought up all that often, because those loans just aren't very plentiful. But certainly on lowering comp voluntarily, if there is a competitive situation, I mean, one of the complaints that I often hear about is what you guys described, right? And like, there's no reason that you shouldn't be able to do that and benefit the consumer if you're willing to take 25 bips less or whatever it ends up being. I think one of the inconsistencies that I often hear is we want to see the LO comp reform, but if it's not going to be reformed, at least we want some regulatory sign, a signal, because it seems like there are companies that are willing to step into the gray and do things that are questionable, let's say, and others that are a little bit more compliance focused. And there's a complaint that creates a very uneven playing field. And I'm curious if you hear anything like that, Justin, or how you advise companies that are, allegedly.
Well, first, I mean, our advice is you should always follow the law, because this has a very long tail, and people forget the liability under the rule is also for the loan officers. So
Sure.
Loan officers and their companies can be held liable for violating the LO comp rule. I'll say two things. One, we have heard that there are more LO comp examinations and that it's more of a focus of supervision. But the second thing is, I'm certainly not saying everyone is perfectly compliant. I will just note that what the guy at the bar says his company is doing and what they're actually doing aren't always the same thing. And a lot of times when I hear, XYZ company is doing something that violates the LO comp rule, and, I happen to know people and we just chat, they're like, well, we've been examined 4 times by the CFPB and everything is fine. So the issue is probably people who have more aggressive or less aggressive regulatory interpretations. And that's why we need clear rules for everybody, right? We all benefit when we have clear rules.
Agreed.
But I don't always know that what you hear is what's actually going on in any given company.
Well, let's switch topics again, shall we? Sure. What happens with this big, beautiful bill that got passed I guess, has it been a year now or 10 months? Anyway.
Yeah.
The cuts on Medicare, right? I don't know exact number. James, do you have a number on that? Like $1
trillion, I believe.
Okay. So here we have elderly homeowners who are going to get affected. I mean, I guess is
Medicaid, right? I think it was Medicaid cuts.
Is it Medicaid?
Yeah.
I'm sorry. All right. I guess the question is how does that affect homeownership? I mean, when we're going to have senior citizens get affected like that?
So where you'd probably see it show up is in loss mitigation, and whoever the owners of their loans, assuming they still have a loan, right? A lot of seniors possibly have paid off their loan or have very small balance loans at this point in their lives. But there's the saying, it's the D's in loss mitigation. Death, disability, and divorce are usually the biggest drivers of life events that require people to have loan mods or do things like that. And to the extent you have people who are no longer able to afford their medical care and go into debt or understandably put more of their income towards medical care, that could have an impact on their ability to pay their mortgage, and their servicers would put them through the loss mitigation waterfall if that were the case.
I think there's another more interesting component here, which is thinking about succession planning and, do you draw down all of the money that you have? Do you take out reverse mortgages? Are there any signs that you guys are seeing already with elderly homeowners that can't afford the medical care, which has skyrocketed, absolutely skyrocketed in the last couple of years? Do the millennials inherit those anymore? If grandma and grandpa owe $185,000 to some sort of private corporation that does healthcare, like what?
So, I mean, this is the narrative story you're telling me makes like perfect sense. This isn't something that we've really looked at or followed, and something we probably should. But everything you're saying logically, I'm like, yeah, this could be an issue, but I don't know it to be one.
And it might be too early, right? And the boomers, still do have quite a bit of money. They have so much equity. Most of them, as you said, are doing pretty well on their mortgage payments if they even have one. But at some point, medical care being what it is
yeah. No, and on the other side of sort of the age curve, what we're looking at is, if the Treasury starts aggressively garnishing wages for student loan borrowers who are in default, a lot of them who took long COVID forbearances, like you could see that show up as issues too, probably more likely in the FHA sector of delinquencies, but that could potentially be something to watch as well, right? Like there's kind of pressures on the consumers on both ends of the age curve.
Something I've been curious about, Justin, or not, sorry, I'm thinking about just the other guy. Sorry about that. Something I've been curious about is that when you guys did that trigger lead thing, what was that, a few months ago, right?
Trigger leads will. So
yeah, it went into effect a couple months ago.
Right.
Went into effect in March. Yep.
How did you guys get both parties to agree?
How we got both parties to agree, and honestly, the answer is loan officers like you, mortgage company execs, and people telling their stories to their representatives through our Mortgage Action Alliance, through coming to our national advocacy conference, and telling the stories of the surgeon who's like, I rely on my phone to get paged down to the emergency room, and when I applied for a refi, like I had 90 text messages, I couldn't even know when I was getting paged to the emergency room, or the people who say I got called 60 times in 2 days. Not annoying and harassing people on their cell phone is thankfully kind of a bipartisan issue. So once people understood how this was happening in practice, they were willing to solve it. And that was really gratifying. But the short answer is it got done through the participation of MBA members engaging through our grassroots and making sure our lawmakers actually understood what a scourge this was.
Was there a point during this that you felt like it wasn't going to happen, or did you feel confident the entire time?
I'm a confident guy by nature, but yes, there's definitely a point, particularly with when it was in the NDAA and then it was out, and we're getting very weedy. But at one point, it was in the National Defense Authorization Act, and then it got pulled out by Chairman McHenry, and that seemed like a really good shot to get it passed. But credit to our LPA team, which is our Legislative and Political Affairs team. That didn't happen. They dusted themselves off, and then they fought the battle in the next Congress, and then we won. So it had its twists and turns, but we got it done in the end.
Justin, what have you guys seen since March? I've heard a couple people who have said that they've had clients who are still getting triggers, but it's way, 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 way smaller than what we saw prior to the implementation of the bill.
So we've heard that too. And my hope is, because the liability mostly now, there's some liability for people who misrepresent themselves to the credit bureaus or obtain credit reports fraudulently. But generally the liability lies with the credit bureaus here. Like they can't provide those trigger leads. And anecdotally, I've heard they're doing things like attestation and making checks on the back end to try and really crack down on them. The only thing I'd say is it's hard to eliminate the calls entirely, particularly like the bottom feeders who are like the scammers and the fraudsters, because they're criminals, right? So it's like a little bit of a joke. Well, a law is not going to stop someone who breaks the law. A new law won't stop people who broke the old law, but it really has cut down on the volume significantly. And hopefully just through enforcement and continued verification and practices at the credit bureau side, we'll see, even less and less of them. But my sense, and I'm interested if you guys have a different view, is it has kind of materially changed the volume that people are getting.
Majorly, very significantly. And kind of on that note, I've heard a number of people tell me that they think the next trigger lead bill is going to be some of these, let's call them AI voice agent calls that are certainly picking up. I don't know if they're quite mainstream yet, but we know of at least one large wholesale lender that is pushing the technology to brokers. There are a couple other vendors that are also pushing similar technology. Where are you guys on kind of using these AI voice chatbots, basically?
No, agents. They're AI agents.
Agents, yeah.
So one thing where we are is we're educating our members, because I think, I'm not by nature a Luddite. I think there are a lot of great things that AI can do, and I'm optimistic for its potential, but it needs to be regulated, and it needs to be well understood the risks you're taking. And what you're pointing out, James, is when you call someone with an artificial or pre-recorded voice, you better have prior express consent, or you're going to be hit with a TCPA violation, because that is what the TCPA governs.
And they're
right. It's right down the fairway for TCPA. So we already have a law that governs to some extent the use of artificial or pre-recorded voice messages, unless people consent. Maybe you're asking a different question that people, even though they consent, don't like it. And then that just might be a market disciplining issue. If customers are aggrieved or annoyed, your agent's not going to do the job it's supposed to do.
Wasn't there a Fannie Mae thing where by April or August 6th or something, they're supposed to have something in governance? What was that? So
it's about AI governance writ large, right? How you as an enterprise are managing all of your AI, which would include sort of your consumer facing.
Right. I mean, that would include the AI agent then, right?
Yeah.
So I think the big thing is that, they have to announce that I'm an artificial, I know Greg Scheer recently had a thing on one of his post where he didn't trust the person. And he asked the person, like, what's the weather outside here in Bethesda, Maryland? And the person couldn't tell them.
Yeah. No. I mean, the agents are very persuasive, but you can certainly usually draw them out and figure out if they're an agent.
In that case, Fobby, that was actually a real person.
Was it a real person?
I'm pretty sure that was a real person. And
how come they couldn't tell out the weather? Because they were supposed to be like right next door to Greg's office or something.
Yeah, the people, it's a very weird thing. I think that it's you get, I mean, you guys know the mortgage industry, like a lot of people are very sales script focused, and they just jump from one kind of prompt to the next. If you say this, I say that, right? I think the person just got too sales scripty and didn't want to.
Right.
That's my opinion. I don't know.
Yeah, no, I mean, I've been in that situation. I was fighting with Xfinity, one of America's least popular companies, and I said, "Are you an agent?" Like, because the person like was, and they're like, "No, I'm sorry, I must sound like one." I was like, "Are you a real?" Like, I was like, "Are you an AI agent?" But it turned out it was a real person.
It's almost like the Matrix, right? Those guys with I mean, it's just
exactly,
we're like on the frontier of that. It's interesting.
Yeah.
So let's stay with this AI stuff. I mean, because look, AI is here. It's not going anywhere, right? The regulatory framework kind of has to be like, we're almost like building it as we go along, it feels like.
Yep.
So where is the MBA's position on this? I mean, where do you guys stand?
So we're in the position of educating our members. I think the technology is a little too early to say like, thou shall do this or thou shall not do that. We should leave space for people to responsibly innovate. But what we do think people need to understand is what I said earlier, is the legal and regulatory environment that you're operating in when you operate with AI. And as a threshold matter, like any consumer finance law that is broken by AI is broken by you, right? Like there's no defense that like, oh, my AI did it. No, you're the company, it's your agent, and you have the liability for that. The second piece of it, and where things are going to get really interesting, is the state licensing side, right? A lot of state laws forbid people who are not licensed from negotiating terms, taking applications, things like that. And the rubber meets the road in kind of interesting ways. So we've actually commissioned an outside law firm to kind of look at that for us. And that's a resource we hope to be able to share with our members very soon.
I mean, so basically what you're saying is like an AI agent would have to pass the NMLS test.
Well, if you interpret the licensing laws to apply to agents, right? You could make the argument that they're written to apply to humans, or you could make the argument that no, it applies to everyone. You do have the requirement to disclose a human on every closing disclosure, right? Like there has to be someone with an NMLS ID, which I don't think you could get for an AI. So it's a really interesting legal problem. And we look forward to the white paper that our friends at ORC are going to put together on that.
Yeah, go ahead. Sorry, go ahead, Jim. No, go ahead, please.
I know actual LOs who are putting like LEs through ChatGPT and Claude and other things, and I think it's insane. I mean, have you provided?
By the way, if they're doing it on the public version of it and not like an enterprise walled up, okay, that's insane. Like
that's insane, right? It's completely insane.
All right, yeah, I'm not your lawyer, but if you're an LO listening to this podcast, don't do that. Stop.
What are the potential consequences for LOs who have done things like this? Maybe they're not as experienced. Maybe they're trying to gain an edge or just improve.
The problem is, and you see this in the legal profession, where if you put something into a public LLM, large language model, it is out in the world, right? If you put a borrower's personal financial information into a public LLM like Claude, like the version of Claude you subscribe to, not an enterprise version that's got control so the data isn't shared out, that data is potentially now out in the world. And in the legal realm, for example, there's a lot of cases that say if you put a legal document into a public LLM, you've waived your privilege to it, right? You've disclosed it to the world, essentially. Same thing with PII and other sensitive consumer information. So it's just a really bad idea to put that stuff in public AI LLMs.
Shouldn't lenders issue a letter to their loan officer saying, hey guys, don't do this?
I think every company should have AI training so people understand the benefits of it and how to use it responsibly. I think it's like any other tool, right? Yeah. For a long time, LOs get trained on social media, right? Here are the things you can say. Here are the things you can't say. You can't advertise rates. You need your NMLS number if you're going to do certain things disclosed. AI is the same way, right? It can be an incredibly powerful tool and really, really useful to loan officers. They just need to be trained and understand what they can and can't do.
we're coming to the end here, and I gotta ask because I think I just thought about this. And it's not on my flow
You gotta
sheet.
ask me about single file credit score, man. That's our other big thing.
All right, go ahead. You wanna answer?
I'm gonna ask you guys. What do you guys think? Do you think if you pull a 730 credit report, you should have to pay for 2 more?
I think we've seen some pretty, and these are probably outliers, but
Yeah.
I've been asking my sources across the mortgage industry to send me a Vantage score 4.0 versus a FICO Classic. And again, I want to be clear. I think these are probably just often outliers, but I'm seeing gaps of like 100-something points. And so that's the only thing that gives me some pause. Like a 730 FICO is probably fine, but a 730 Vantage score, I don't quite know.
So we're having. I agree with what you're saying, but we're having a little bit of a different conversation. We have credit score adoption, right? So we're adopting credit score, Vantage score, versus FICO Classic, and it seems like 10T is right around the corner. But MBA's big priority is, like, we believe fundamentally that competition is good in markets and good for consumers. So we now have, and you're right, James, we need to see how it shakes out. We now have credit score competition, but we believe that there should be competition in credit reports. And above a certain score threshold, you don't need to pay for 3 reports. You don't need to pay for Experian, TransUnion, and Equifax. You pull a 770, and let's say score agnostic for the moment, okay? Be it Vantage or FICO. If you pull a 770 from Bureau A, you're done, right? You don't need to pay for 2 more reports.
Yeah.
And our view is that will help drive down the cost of credit scores, because functionally the credit score problem is because of a monopoly that's been granted to the 3 bureaus from the GSEs. So our advocacy is that the GSEs should rescind that monopoly above a certain credit report and score threshold, and only require you to pull 1 bureau.
I'm good with that.
But I mean, isn't the pushback, like, what if the other 2 scores are significantly lower than 770? What if they're 695 and 710?
So, well, I mean, if you look at the default curve, and it's a fair thing to say, like, what about the loans that were not approved? And so let's put that to the side.
Mm-hmm.
But if you look at some recent AEI research, they actually show that in terms of predicting 90-day defaults, all 3 of the bureaus perform about as well as the tri-merge. And it's a really tight fit along those lines, Bureau A, B, and C. Now, of course, you will find outliers, and we can't say that, like, every single borrower, they're going to fit tightly. But if you have good gaming controls, that relationship should hold up, right? What you don't want is people cherry picking the highest score. But if, say, you're a TransUnion lender or an Experian lender for a month, 3 months, and that's what you pull, the outliers, in my view, because those fits are so tight, should be normally distributed, right? So, like, yes, maybe there would be an instance where some are higher or lower, but it doesn't seem like it's systemically a problem with one bureau or the other. Because if it was, you'd see the breakdown in that relationship with respect to the tri-merge.
Yeah. I mean, you're talking to a guy that was in the business when there was no credit scores. And so life was really good back in those days for me.
We're trying to get the GSEs to allow single file, but if you want to try and get rid of all of it, I'll let you carry that one. That's going to be a harder.
I mean, my understanding of the credit scores, and correct me if I'm wrong. I mean, I'm not an expert on credit scores or at all, but they're mostly driven by revolving debt, not the mortgage debt. And
there's multiple trade lines.
Yeah,
it's credit cards, it's auto.
Right. So what I'm getting at is
mortgage is very heavily weighted on.
Right, and so everyone knows that your housing is your prime most of the time. You know, I mean, overwhelming population is your primary purpose of your. If you can afford to make a payment, you're going to make your housing payment before you make other payments.
Sure.
So
I mean, we talked earlier about medical. I think that's probably the thing that jumps the line for everything for obvious reasons. But generally consumers will take on credit card debt, other debt, and try to pay the mortgage because, like, it's home, right? That's where they live.
I mean, unlike in 08, 09, we saw where people were paying for their car payments before they made their housing payment because the car, they said, was taken to their job. I'll never forget that phone call. I was on that phone call. And so they were making their housing payment, they're making their car payment. And it was just, I
haven't seen the data on that, but generally it seems people try to make the mortgage payment.
Yeah, no, that was a very specific time when the values had dropped 30-40% and people were like feeling defeated and that all it was just
okay. So if you were in a product that you knew was like an escalating arm that you were never going to catch up to, and home values had cratered. Yeah, I could see someone saying,
So
I can never get ahead of this.
It was a different time, but I remember that phone call. That's why it's always been stuck in my head where this lady was like, no, I got to pay my car payment because that takes me to my job. I was like, wow, here it is. You know what I mean? But
and people got to live their lives. Yeah.
Yeah. So look, I don't know. I think I'm not sure where we are with the credit score, but I want to know about this one thing: lawsuits between mortgage lenders and loan officers. Because I don't know if you guys have an opinion on that. I don't know, right? But it just seems like, for me, from my vantage point, it seems very silly, and it doesn't seem like it solves any problems. Where they say, "Oh, look, this group left, and we're going to sue them," and blah 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 blah, and then next thing you know, there's this legal battle. Lawyers are the one who end up with the fees. At the end of the day, there's really a settlement, and no one ever really gets to any end justice. So, any appetite on that topic?
I mean, I don't think there's not an MBA position. As a lawyer who's not a litigator, I will say that a lawsuit is a messy and ineffective mechanism for achieving justice or anyone feeling great at the end of the day. Yeah. But on the other side of the coin, people who sign contracts have a right to enforce their contractual rights as they understand them. So it is a messy thing, but as a general rule of thumb in all life endeavors, you're probably better off not suing someone, but sometimes you have to.
James, I mean, you're in the mix of all this stuff, so you hear about the lawsuits and the people. Like, I mean, what's your take on this?
I think generally the industry is too litigious overall. I mean, even in doing completely truthful reporting that is substantive and sourced, I get legal threats pretty regularly because it only costs $200 to send a nasty letter to scare somebody. So I think you see a lot of that in general in the mortgage industry, and I wish that were different. But related to this question, yeah, I mean, it really comes down to, okay, did someone take $500,000 and agree to a 2-year, 3-year term? And if they leave after a year, well, yes, obviously you are going to have to pay that money back, right? Somehow. And you're not entitled to the P&L, even if you think you are, and you're getting monthly statements, like it's not your money, right? So that's part of it. And it still surprises me that a lot of LOs don't think that someone's going to sue them because they have so many lawyers on payroll and they've proven time and time again that they're going to do it. So, I don't think they should. I think there are better ways to come up with some sort of agreement. But if the LOs keep accepting these big signing bonuses and they leave before the terms are up, we're going to keep seeing this, especially as bigger teams are moving and they're doing so, like the dead of night, because it's like Washington crossing the Delaware.
I'm not even talking about the clawbacks. I'm talking about like, you took our data, you took our proprietary information, that kind of stuff. You know what I mean? Where
if you take company trade secrets, I mean,
they're
people are going to enforce their rights to that. I mean, that's like in all things, understand and this is also, I'm not your lawyer, but general legal advice. Like, if you sign a contract, you should understand and abide by the terms, or expect that the other party to that contract might seek to enforce those terms.
That might be a pretty good education series for the MBA, by the way, is to actually go through a sample contract. I'm not joking about this because
that's actually that's a good idea. I mean, we generally wouldn't do standard forms because there's a lot of legally compliant contracts you can write, but just an education series, that's a good idea. Or maybe I can recommend someone to do it on this pod for you.
Sure. More than welcome to come back anytime you want, Justin. Seriously, because I don't think a lot of loan officers really understand that they're signing a contract. I'll be frank with you. The reason I'm kind of like, because I've been sued by three different lenders, right?
Yeah.
2 of them were absolutely frivolous. One was they got me because I signed a stupid contract that my ego did not see the fine print, and I did not show my attorney that contract. You know what I mean? And live and learn, right? But I don't think a lot of loan officers do that. I don't think a lot of mortgage professionals go take that contract, say, "Hey, review this for me and charge me $1,000 or $2,000, whatever it is, to review it."
There are non-competes as well, which I think is pretty questionable in this day.
It depends. I mean, depends on the jurisdiction, right?
Yeah.
Like,
totally.
Enforceable in some states, not enforceable in others.
Yeah.
I mean, I think it's just I feel like as an industry we just need to become more friendly. That's all. I mean, everybody's like I said, it's a carousel, man, and people are doing like, you know what I mean, like whatever happened to the clean hands. Like if you sue somebody, then you shouldn't be doing the same thing on the other side. So anyway, Justin, you're very quiet.
I was about to say, like, I love it. Like, who was it? Why can't we all just get along?
Yeah, I mean, to me, it's like, just be cool, man. You'll be fine. Like, you're not gonna lose anything. Like, you lost a $100 million group, you'll get another $100 million group. You know what I mean? It'll come around. Anyway, that's just me venting, Justin. I'm sorry.
I know. I mean, I'll send you the bill for the therapy, but I have to listen.
Actually, there's another Justin that's on the show, Justin Neal. He gets to hear my venting about lawsuits more than anybody else. So anyway, listen, you've been a great guest on the show. I appreciate you coming on here.
That was great. Had a great time. Thanks for having me.
Anything interesting on the horizon of the MBA that we should be aware of?
Annual convention is going to be in Chicago. It's going to be a great time. I think they just announced Jerry Seinfeld as the comedy concert. It's a kind of an optimistic time in the industry. The conferences I'm at, the energy is good. People seem to be making deals, and hopefully we'll see enough of a rate pullback that we'll actually get some refis going at the end of the year. So our energy is good, and hope to see everyone out at Annual.
And I think people should book their tickets now, because the first day is a Sunday, and that's also the day of the Chicago Marathon. So it's going to be very busy.
Well, also just, with the price of airfare because of the fuel issues, like anywhere you're going for your summer vacation or for Chicago for Annual, book your ticket now, because it's going to be more expensive in 2 months. Wow.
I didn't even think about that. Like, the airfare could be even higher than it is right now, huh?
Yeah. Yeah, a lot of people are like travel experts are saying you should book now.
James, I'll just come to New York and pick you up, and we'll go drive to Chicago together. How's that?
There is a train. You guys could do like a travel hop on the train. Yeah.
We could do the plane, trains, and automobiles, the movie. Me and James all together. Anyway, Justin, listen, buddy, thank you so much for coming out here. This was a good episode for me. I hope you had a good time. James, thank you for being a special co-host this time. And I know there was a jackhammer behind you. We did not hear the jackhammer once.
That's great. I'm glad to hear it.
You guys in Brooklyn know how to jackhammer behind people so we can record our podcast. Tell them kudos. All right?
I will.
All right, guys. Thank you so much for being on here, guys. We'll talk to y'all soon. Have a good one.
Talking leadership, making the big plays in the mortgage game through the sun and the haze. Close more deals, build your success. Time to level up and beat the stress. Get ready to laugh, land and eat. Your weekly sing.